and you see China kind of rolling out its yuan-based oil futures, and then now, of course, shifting into its central bank digital currency, which can potentially, give it more flexibility in terms of global payments. And so overall, my thesis is that we're going to see, a handful of the top currencies be able to be used to buy oil.
We've been in a dollar system really since the end of Bretton Woods, and you think that system, it's encountered so many challenges, but it's remained strong, remained robust. You think that could roll over, and actually the dollar system could, as you say, fray and disintegrate. Tell us about why you think that is.
So the short version is I think we're seeing a decentralization of energy pricing longer term. And so, from 1944 to 1971, we had the Bretton Woods system. Currencies around the world were pegged to the dollar is pegged to gold. Now that, the United States defaulted on that system. We did not really have enough gold to maintain that peg. And so since then, currencies became free floating. And the United States ran into headwinds associated with oil embargoes and things like that. But in 1974, the United States made a deal with Saudi Arabia and then eventually other OPEC countries where they said, okay, only sell your oil in dollars, no matter who's buying it from you. So if it's Europe, if it's Japan, if it's us, doesn't matter. Only sell it in dollars. And in fact, take those dollars and preferably use them to buy treasuries and hold them as your reserves. And then also, in exchange for you doing that, the United States would provide protection so that it helped keep supply chains open, help keep, relative peace in the Middle East for countries like Saudi Arabia, and also do, lucrative arms deals. And so overall, I would say that, a more decentralized system in the longer run would be a more stable system because in addition to having, no single central bank being able to respond to it, there would also be no single bottleneck quite as big as the current system, which is that we have all this dollar-denominated debt in the world relative to the amount of dollar cash flows and the size of the U.S. economy. So those three currencies that you mentioned are the ones we're seeing signs for. So Russia's shown an interest in selling oil in euros. We've also seen, if you look at trade between China and Russia, it has rapidly de-dollarized over the past 3 years, and the euro has been the biggest beneficiary, even though obviously the euro is neither of their currencies. We still haven't seen a lot of action out of China's currency, but I do think that the launch of their central bank digital currency could accelerate that, at least among some of their local peers. Russia, as well as the connections they have with some African nations in terms of lending. I think that's something to watch as well. Now, that doesn't necessarily mean, it depends on the country what they want to hold it in after they do a medium of exchange. And so Russia's shown a tendency to want to hold their assets in gold, for example, at least a good chunk of their foreign exchange reserves. And so, I think we're seeing that diversification. So that can mean, for example, that foreign central banks buy less treasuries or fewer treasuries than they did, say, in decades prior. And so that forces the United States to fund itself either through private sector or through the Fed. And so we're seeing, for example, that the Fed now holds more treasuries than all foreign central banks combined. And it's possible that, if we go out longer, that the Fed will hold more treasuries than the whole, international sector combined, private and public. But right now, the Fed has already, surpassed, official holdings for central banks in terms of holding treasuries. So we're basically eating our own cooking now. And so both sides of that spike would in theory be lessened. And so, if you go back to, say, neutral reserve asset like gold, for example, there's no one that can bail out the system by suddenly creating a ton more gold, but also debt levels don't get as high in that sort of system to begin with generally. It generally takes these sort of deliberate policies to build up those debt levels. And, for the dollar specifically, the United States has been promoting the usage of its currency, promoting kind of the, getting emerging markets indebted, and then basically also provide, it's kind of like, we're getting them indebted, but then when it starts to break, we provide them a lifeline to get them just enough, out of the debt to be stable while still being heavily in debt. And so this system is kind of, perpetuating itself. It's being managed so that it kind of doesn't go towards the breaking points too much, at least for a majority of countries. Occasionally one country breaks here and there, whenever the dollar gets too strong. And so that's been a system that's been in place now for over 45 years, where Saudi Arabia just only sells their oil in dollars. And even though, I mean, now, for example, if you look back when that system was started, the United States was maybe 35% of global GDP. We were by far the biggest commodity importer. And over time, the United States GDP has fallen, more like 20%, even potentially lower depending on exactly how you measure that. China's become the world's largest commodity importer for most commodities. And the United States has also become somewhat more self-sufficient on oil, so we're no longer Saudi Arabia's biggest customer. We're starting to see, for example, Russia, which is obviously one of the largest energy producers, has shown an interest in aggressive de-dollarization and shifting towards euros, gold, yuan, basically other assets. And so Russia has begun selling their oil in euros, uh, you know, basically as part of their diversification strategy. And you see China kind of rolling out its yuan-based oil futures, and then now, of course, shifting into its central bank digital currency, which can potentially, give it more flexibility in terms of global payments. And so overall, my thesis is that we're going to see, a handful of the top currencies be able to be used to buy oil. And then we're also, by extension, going to see somewhat of a diversification in the currencies that different countries use for their foreign exchange reserves, so that the dollar will shift from being the world reserve currency to being one of a few regional reserve currencies, alongside neutral assets like gold, and if it gets big enough years from now, possibly things like Bitcoin. I would kind of counter by saying that in that more decentralized world, you'd have less of a specific bottleneck as well. So the conditions that ran up to that dollar spike would be less, in addition to the fact that the ability of one central bank to respond to that spike would also be less. If you look at, different countries, the Fed still has, a relatively low percent, like it's the central bank assets as a percentage of its GDP are still on the lower side compared to, say, Japan or Europe. We had these periods where we're catching up to some extent. And so the way I describe it is that the United States is we are running the biggest, say, fiscal deficits among our large peers. That's kind of our key difference. And we're also, we have these structural trade deficits that they don't have. I think those are the parts where the United States kind of stands out as problematic. Whereas the fact that, we're eating our own cooking mainly makes the United States just like these other countries rather than standing apart. So it kind of fits in that thesis where the United States dollar becomes a regional reserve currency, rather than like the world reserve currency. It starts to look more and more like some of these other large developed market currencies. I don't know about hundreds, but that certainly takes a long time to play out. It's what I'm looking more is to see if our net international investment position stops decreasing as a percentage of our GDP, starts stabilizing, and then maybe turning up from that low base. And so I'm kind of watching that pretty closely. So for people that aren't familiar, a country's net international investment position is a measure of how much foreign assets that country owns, minus how much of their assets are owned by foreigners. And so, for example, Japan is a very large creditor nation. They have a positive net international investment position, which means that Japanese households, companies, government, they own a lot of assets around the world. They own treasuries, U.S. treasuries. They own U.S. stocks. They own European stocks. They own companies in Europe. They own companies in the United States. They own real estate. And so they own more foreign assets, and they have a large inflow of dividends and interest and other sources of income from those assets. And so they're a creditor nation. On the other hand, the United States is a debtor nation, so we have a deeply negative net international investment position, meaning that because we've run these structural trade deficits, so you know go back to Japan for a second, because they ran structural trade surpluses, they got all these dollars and other currencies flowing into them, and they used those to buy those foreign assets. Whereas the United States, on the opposite side, we're running these structural trade deficits. We're sending dollars out to the rest of the world. The rest of the world is using those dollars to buy our assets. And so we're basically selling them, parts of our equity base, parts of our real estate market, parts of our government debt. They're increasingly becoming owners of U.S. assets,